In the realm of cryptocurrencies and blockchain technology, one of the biggest breakthroughs in recent years has been the rise of decentralized finance, or DeFi. The word DeFi describes a group of financial services and apps that run on decentralized networks, like Ethereum, and are not governed by conventional financial institutions or middlemen. The total value locked in DeFi protocols soared from less than $1 billion in early 2020 to over $80 billion in April 2021, demonstrating the exponential expansion of the technology. A number of reasons have contributed to this explosive growth, including as the growing acceptance of blockchain technology, the need for more financial independence and control, and the possibility of large investment returns. But this expansion also brings with it a number of hazards and possibilities that need to be investigated further. In this video, we will delve into the rising DeFi landscape, its current state and potential future, the opportunities it presents, as well as the risks that come with it. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. The current state of decentralized finance. Over the course of the last 2 years, decentralized finance has seen tremendous growth. As of May 2021, the total value locked TVL in DeFi protocols has increased from little over $1 billion in early 2020 to $86.5 billion. Decentralized exchanges, DEX, lending protocols, and yield farming, which enables users can generate large returns on their cryptocurrency holdings by lending liquidity to other protocols, have all contributed to this startling rise. With overall trade volumes on DEX like Uniswap and SushiSwap exceeding those of centralized exchanges, CEX, in recent months, these platforms have become prominent actors in the DeFi ecosystem. This demonstrates the rising customer preference for DeFi and the need for decentralized, trustless trading platforms. Financial dApps like Aave, Compound, and MakerDAO are also becoming more popular as substitutes for conventional lending and borrowing practices. Through these apps, users may lend out their cryptocurrency holdings to others and earn interest on them without the need of middlemen like banks or payment processors. The DeFi community has also been enthralled with yield farming, which is staking cryptocurrency assets in liquidity pools to generate returns via transaction fees. High yields have drawn additional users to the area. Yield farming does, however, include certain hazards, which we shall discuss later in this post. These risks include temporary loss and smart contract weaknesses. DeFi's promise extends beyond its ability to provide financial services and goods. By doing away with the need for middlemen and centralized authority, it also has the power to upend and transform established financial institutions. This may result in lower transaction costs for consumers and greater financial inclusion, particularly in areas with restricted access to conventional financial services. Opportunities presented by DeFi. Decentralized and trustless financial system. The removal of middlemen and centralized authority is one of the primary benefits and possibilities offered by DeFi. The foundation of traditional financial systems is confidence in middlemen like banks, payment processors, and governments. DeFi protocols, on the other hand, function on decentralized networks where smart contracts are used to verify and carry out transactions, doing away with the need for middlemen. This makes the financial system more effective and transparent while also lowering the possibility of fraud and manipulation. Increased access to financial services. By giving people who don't have access to conventional banking services financial services and products, DeFi has the potential to improve financial inclusion. Anyone with an internet connection may engage with the global market and conduct financial transactions using DeFi. People in underdeveloped nations where access to standard financial services may be limited may find this to be very helpful. High-yield opportunities. The opportunity to earn large returns on investments is one of DeFi's main attractions. Due to the very low interest rates that conventional banking institutions give on investments and savings, DeFi platforms that provide double-digit APYs have grown in popularity among consumers hoping to profit greatly from their cryptocurrency holdings. Innovative financial products. Traditional financial systems would not have allowed for the development of novel and inventive financial products like prediction markets and synthetic assets, but DeFi has. These solutions serve a wider spectrum of consumers seeking out various investment possibilities by enabling more intricate and diverse investment opportunities. Democratization of finance. The fundamental idea behind cryptocurrencies and blockchain technology has always been decentralization. DeFi brings this financial system decentralization to a new level, democratizing finance. Regardless of geography or financial situation, anybody with internet connection and a cryptocurrency wallet may use financial services and engage in financial transactions. Risks in decentralized finance. Smart contract vulnerabilities. Smart contract vulnerabilities are a serious danger that DeFi systems must contend with. Automating transactions and enforcing trustless interactions are the uses of smart contracts, which are self-executing contracts on the blockchain. but if the smart contract's code has a defect or weakness, it might be used against it, resulting in money loss or theft. Users have lost millions of dollars as a consequence of similar instances in the past. This emphasizes how crucial it is to carefully audit and verify smart contracts before integrating them into the DeFi ecosystem. Impermanent loss in liquidity pools. Yield farming, as previously stated, is staking cryptocurrency assets in liquidity pools in order to get payouts. When offering liquidity, consumers must realize that they are assuming a certain amount of risk. Impermanent loss, which happens when the value of the staked assets differs considerably from the pool's worth, is one of the hazards. When the staked assets are removed, their value may decrease as a result, in contrast to keeping them in a wallet. By selecting the appropriate pool and using techniques like impermanent loss mitigation tools, impermanent loss may be reduced to a minimum. Regulatory challenges. DeFi's decentralized structure presents major obstacles for authorities. Regulators oversee and manage financial institutions and intermediaries in conventional finance. DeFi, on the other hand, lacks a centralized authority or regulatory middleman. Due to the difficulty in enforcing laws and regulations, DeFi platforms may be used for illegal purposes, including funding terrorist operations and money laundering. Regulators are expected to intervene as DeFi expands and enact rules to protect users and reduce hazards. User errors/scams. DeFi's decentralized structure also ensures that users are in complete control of their money. There is no central authority to reverse the transaction or retrieve the cash if they make a mistake, such transferring the payments to the incorrect address. Furthermore, because DeFi is permissionless, con artists may simply design phony protocols to fool users into transmitting their money. In order to mitigate these kinds of dangers, it will be essential to educate users about the risks and appropriate practices as DeFi becomes more widely used. The future of decentralized finance. Decentralized financial services and products are in high demand, as seen by DeFi's phenomenal development. We anticipate seeing even more cutting-edge DeFi apps emerge as blockchain technology gains traction. Nevertheless, before DeFi can realize its full potential, a number of issues must be resolved. For DeFi to keep expanding, the Ethereum network's scalability problem must be resolved. The network is becoming more and more crowded due to the growing number of users and transactions, which leads to expensive gas costs and slower transaction times. This restricts the adoption and reach of DeFi by making it harder for smaller investors to take part in transactions. DeFi's expansion also depends on various blockchain networks being able to communicate with one another. The majority of DeFi protocols now in use are restricted to using assets that are compatible with the Ethereum network. Facilitating the smooth movement of assets across other networks will increase possibilities and promote more usage. Clear regulations are also required for DeFi to be widely used. DeFi's decentralized structure makes regulation difficult, but explicit rules from authorities will provide users and developers of the platform the much-needed structure to work within. Conclusion. The emergence of DeFi has created a wealth of opportunities for the financial industry. It has the potential to completely transform established financial institutions and provide millions of individuals access to financial services globally. These chances do, however, carry a major risk, therefore they should not be embraced carelessly. Users must educate themselves on the hazards and best practices associated with DeFi as it develops, and authorities must provide a clear framework that will allow the sector to grow. DeFi has the ability to transform the way we interact with money and become a significant player in the financial industry with these safeguards in place. This is it for today's video. What do you think of our video? Comment below with your thoughts and let us know. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.